Entry, exit, stop loss and target are the four pillars of any trading system. But there is one more pillar which usually goes unnoticed and is heavily underrated, and that is called trailing stop loss. Not letting the market take back the gains after the trade goes in your favor is one of the most important aspects of trading. But it's not as easy as it sounds. It requires deep understanding of charts, skill of execution, and most importantly, your trust on the markets. In this video, we are not only going to understand the exact process of how to trail a stop loss, but also going to go through a couple of examples which will help you understand the concept and the process in a crisp and clear way. Hey guys, welcome back to the channel. This is Shrish here from Trading Explained, and now, without any further ado, let's begin. So we will divide this video into three parts. In first part, we will understand what is trailing stop loss. In the second part, we will understand how most people trail their stop losses. And in the third part of this video, we will see the correct way of trailing a stop loss. So let's begin. So number one, what exactly is trailing stop loss? So trailing stop loss in simple words basically means moving your stop loss in your favor as the trade starts to go in your favor to reduce the risk. Let's understand this in a much simpler and a better way. Let's say, for example, this is a stock chart, and on this breakout, you buy this stock at, let's say, 100 rupees. Okay, 100 rupees is your buying price. You keep stop loss, your initial stop loss at 95. And let's say now, after you buying over here, your stock starts to go in your favor. So now let's say after some time, the stock is trading at 110. So now what you will do to reduce this initial risk, you will remove the stop loss from 95 and place stop loss at maybe 100 or 102 or 105, etc. Basically, trailing stop loss is a way of restricting market to take back the gains that it has given to us. But it is not as easy as it sounds, as I told in the intro, because market knows that people are going to trail those stop losses, and most of the time market comes back to take those trailing stop losses. So we will understand this in second and third part of the video. So now that you know what is trailing stop loss, let's head to the second part of the video to see how most people trail their stop losses. And yes, this is not the right way to trail stop losses. I am just showing how people trail stop losses, and that is the wrong way, and that is why most people are losing money, right? So what people do? Okay, so here's a chart. It goes up, comes back down, goes up, comes back down, and on this breakout, okay, people buy at this breakout. I'm just showing a very simple example. So people buy at this breakout. Now what happens? Market goes up, comes back down, and goes back up again. Now what theory tells us? Books tell us that whenever market goes in your favor, comes back down, makes a retracement move and starts to move up again, you need to trail your stop losses below that point. In this case, this red color line I am marking over here, this is that point. Why? Because according to theory, market retraced back after going in your favor, and that retracement move made a low which is going to act as a support in the near future. And that is what books tell us, that remove your initial stop loss from this point and keep it to this point. And this is how most people trail their stop losses. But what market does? Market knows that people are trailing stop losses. So market will do this. It will go up, come back down, take these stop losses, and only after taking these stop losses, only after taking these people out, it will move up. So this is called stop loss hunting. I have already made a video on stop loss hunting, and if you want to understand more on the subject, please go and watch that video first, because then it will be very much easier for you to understand this video. Okay, so this is called stop loss hunting. Market knows, the operators knows where you are trailing your stop losses, where your initial stop losses are, and that is why market comes back down, takes you out, and then goes in your original direction, then goes in the direction that you thought the market would head to. And although most people are right on the direction, still end up losing money because they trailed their stop losses the wrong way. Okay, getting my point? So let's see another example. This was example for the long side. Let's see for the short side. So let's say the market goes like this, retraces back and breaks down below this previous support. So what most people will do, they will short at that point because that is a breakdown. Well, shorting at that point is not a problem. So what most people will do, they will short at this point and keep their initial stop loss over here. That's okay. Okay, then what market does, it goes down, comes back up, gives a retracement move and then goes back down again. And now market basically tells people to trail their stop losses at this point. So that is what people do. People remove their stop losses from this point and trail their stop losses to this point. Now yes, they reduce the risk, but that is not the right way again, because as I told you, market knows that there is liquidity at this point. Market knows that there are orders that are lying at that place. So what will market do? These biggies know everything. So they will take the markets up, kick you out, your trailing stop losses are out, and now the market goes back down. So this is an everyday story of a retailer. People think that they were right on the direction, they knew the markets were going down, but still they could not make money. And what is the reason? There are many reasons, to be honest, but this is one of the reason. Trailing stop loss is one of the reason. Not trailing the stop loss in a right way results in loss or in kind of potential loss, because if you trail the stop loss the right way, you would have caught this move. And that is basically what is happening with retailers every day. So now let's head to the third part of the video and understand what is the correct way of trailing a stop loss. So what I am going to teach you now, I have learned it the hard way. I haven't learned it from theories and books because it does not exist there. I have learned it the practical way, and that is by taking multiple losses and learning from them. So what is it? What is the right way to trail a stop loss? So the right way to trail a stop loss is, let's understand with the charts. So market goes this, comes back down, breaks out. Same example, but different perspective about markets. So what will most people do? Usually people buy at this point considering it's a breakout. No harm buying in a breakout, no problem. But what most people do after that, we saw in the second part that they trail the stop loss the wrong way. So the market goes up, comes back down, goes back up again. And at this point, most people remove their stop losses from this point and place it at this point. And this is the mistake that retailers are doing. This is the mistake that I used to do so many times. I did not used to understand why, despite being right on the direction, why despite catching the trend, I am not able to make money. And this was frustrating for me, and it must be for you as well, because we kind of understand markets, we kind of predict, analyze, anticipate where the markets are going. Markets end up going that way and we still do not make money, and that is frustrating. I can understand. I have been there. So what is the right way? The right way is to show patience. I talked about 3 things in the intro, and those were deep understanding of charts, skill of execution, and your trust on the markets. Now the trust on the market part is basically where the game is. You need to trust the markets blindly if you have caught the direction right. If you are in the trend, if you know you are right, if you know the direction is right, you need to show the trust to the markets. Only then markets will give you money. And this is how it works. I'll explain to you what I mean via charts. So most people, as we talked about, will trail stop losses over here. And that is where, as I told you, people are going wrong, because market knows that stop losses are there. So what will market do? Market will come down, take these stop losses and then head up. So what do you need to do in this case? So first, don't trail your stop loss immediately. Don't trail your stop loss the moment you see a retracement move taking a support. That is the worst possible place to trail a stop loss, because market is screaming and telling people to trail their stop losses, and that is what most people do, and that is why it never works out. So what do you need to do? Number 1 is don't trail your stop losses immediately the moment you see any retracement move making a support. Don't do that. You need to wait until that support level is breached and the markets reclaim that level back. What do I mean by reclaim? By reclamation, I mean markets break that level and immediately go back above that level, which happens over here. And now you need to trail your stop losses from this point to this point. This is the correct way of trailing a stop loss. Showing patience and trusting the markets, because market knows you are placing your trailing stop losses at this point. Market knows everything. So market will come back to take those stop losses. And once that stop loss hunting is done, then you need to trail your stop losses. That is the correct way. And now let's head to the last part of this video, and that is the examples part. And you will see this exact same thing working in Nifty and Bank Nifty like charm. So let's head to the charts now. Over here, this is 17th March 5 minutes chart of Nifty futures. I have placed 3 indicators over here. One is VWAP, one is pivot points, and third is volume. I'm not using anything else. VWAP is just to give a context of who is in control of the markets, whether it's bulls or it's bears. Pivot points for booking with the profits, and volume for understanding what is going on in the markets. So over here, let's talk about the basic examples that I showed you in the drawings right now. So let me mark one resistance. Okay. So this was the resistance for the markets. Why? Because the market opened gap up. There was a huge gap up. It opened gap up, went down, went up, and then made this resistance. After that resistance, market consolidated a bit and then broke out above the resistance level. So what will most people do? They will buy at that zone. 17,298, 17,300 is basically the level where most people are going to enter. So what is going to be their initial stop loss at this point? Well, there can be multiple levels for placing stop losses, but as far as I understand, if this breakout fails and comes back into the range again, then that means that breakout was a fake out and you need to get out. So most people will place their stop losses where I have placed my purple line. Conservative people will go a bit below that, most probably over here. So now what market does, it goes up, breaks the resistance, goes up and forms a good green candle. So you need to focus only on the right side of the chart right now. So after looking at this good green candle, you can call Marubozu if you want to. We don't care of the names, we just care of the patterns. And that is a good green candle because it engulfed the previous red candle, showing that bulls are in total control. So what will most people do? Most people will remove their stop losses, their original stop losses which were placed over here, and place below that green candle now. Because if we switch to the line chart now, this has formed a base at this point. And as I told you in the drawings, people like to trail their stop losses below those bases. And then what happens next? Market takes out that base and then shoots up higher. Why people do this? Because they believe that if market comes back down after this green candle is formed, bears might take the control and they will lose their profits. And if you understand, this mentality is coming out of fear, which again is emotional trading, and emotional trading can never be profitable, you know that. So let's see what market does next. Focus on the right side. Market makes another good green candle. So half of the people might trail below the low of that candle, or few will keep the original stop loss as it is. And now market makes a red candle, a Marubozu candle, a engulfing candle that completely engulfs the previous green candle. And now here fear starts to kick in. Here the fear starts to kick in. Now the next candle is again a huge red candle. Now this red candle takes out the stop losses of most of the people, the trailing stop losses I mean, because over here aggressive trailing stop losses are out, and over here the conservative trailing stop losses are also out. But let's say the person who has kept his initial stop loss as it is has not moved it an inch. Let's see what happens to that person. So here is where the trust comes into play. He knows that the gap up is there, the direction is there, bulls are in total control, resistance has been broken. He knows that market will go up. He knows that this is just a retracement and not a reversal. Understanding the difference between those two is very important. Okay, see what the market does next. Okay, so the third red candle appears, and at this point probably everyone thinks that this is a reversal. Probably everyone thinks that the markets are not going to go up now, it is going to reverse back down. There are going to be people who trail their stop losses to cost as well, just to avoid the risk. And this, if you see, it was your entry at this point, market comes back to take those stop losses as well, those stop losses which were trailed to cost. So market basically knows where your trailing stop losses are, but there are going to be probably 1 or 2% of the people who did not trail their stop loss despite market going in their favor, and those are the people who get rewarded. Let's see how. Market formed these 3 bear candles, red candles, and then boom, a green candle. And now you know that this base is formed. Now you know that yes, now you are ready to trail your stop losses from here to the low of these candles. Why? Because the base has been formed. There is a big green bullish engulfing candle that is there, which gives you a confirmation that this retracement move is now ending. Okay, let's see what the market does next. So now if you see, this is the correct way of trailing a stop loss. This is the correct way of managing a risk. This is also a part of risk management. Risk management is not only about risking 1% or 0.5% or 0.7% on a trade. This is also a part of risk management, isn't it? Managing your risk correctly is not only about maths, it's about understanding the charts also. And now the R4, as I told you, the pivot points are there for booking profits. So the market reached to R4. You are free to book your profits at this point, and if you don't, then the markets will take those profits from you. So having a system is important, and following that system is even more important. So as I told you, I use these pivot points for booking profits. This is exactly why, because if you see, your entry was now at approx 300 rupees. If you trailed your stop losses, you got hit out at 310 to 315. But the person who did not trail the stop loss and kept the trust in markets and waited for the correct price to trail the stop loss actually ended up getting more than 50-55 points. And this is how the market rewards the 1% of the people. And this is why most people, despite being right on the direction, end up losing money. Let's see another example. This one was Nifty. Next one will be of Bank Nifty. So here we are with our Bank Nifty chart, and this example is going to be of breakout failure. So in Nifty we saw example of breakout. This example is going to be of breakout failure. And for this one I am going to mark the opening range. So if you haven't watched the opening range video of mine, please go and watch that first, because if you don't watch opening range, you won't understand what is going on in this example. If you have watched already, great. So for this particular example, I am going to make use of opening range, because opening range breakout is a thing that most people use. Okay, so we need to focus over here, 15th of March, and this was the opening session. I have marked the opening range over here, and what happens over here was there was a opening range breakout, but as you can see, there was an immediate resistance above the breakout zone, which was the intraday R1 pivot point. And as I told you, pivot points are used for booking profits by most of the professionals. Market does respect those levels. So even after breaking out, market got rejected from there and came inside the range again. And once a breakout comes back inside the range, it is called a fake out, because it is not a breakout anymore. It just faked the breakout and it is now trapping the bulls at this point. So what can be done at this point? You can short the markets at this point, because you know that this is a breakout failure. So you can short the markets over here, keep your stop losses above this highs and wait for the markets to go in your favor. That is how we trade, right? So assuming you shorted the markets at, let's say, these levels, 35,575, 35,580, these levels you shorted, and your stop loss is at 35,680 or so. Okay. Now what happens? Market goes down in your favor, you are in some profits, and then the consolidation starts. And now what happens is people trail their stop losses. people will bring their original stop losses from this point, like this was the original stop loss point. From this point, they will trail their stop losses to maybe cost, or maybe over here below cost to cover the brokerage charges, whatnot. Okay, people see that this high is being formed as well. This particular high is being formed, so most people will trail the stop loss above this high, considering that now the market has kind of given a retracement move and it could not retrace that much because of the bears are there and everything. But this is the wrong way. As I told you, market knows where the trailing stop losses are there and market goes back up again. Even if you trailed your stop loss to cost, you're out. Just as we saw in the first example, even if you trail to cost, market is going to come to the cost. So what you need to do, you need to trust the markets. You need to remove that fear of being wrong. You know that you are right, you know that you are in the trend, you know that you have caught the direction right, then what's the fear about? Just trust the markets. And as I told you, there are going to be only 1% or 2% of the people who are not going to trail the stop loss despite this down move are the ones who are going to get rewarded. Because the market goes up again. See the pattern is very similar. 3 green candles. People think now it's a reversal. People think the bears are dead. People think the bull are coming in. And now, in fact, in this one, 4 green candles. But then, see this. See this reversal. It did not take your original stop loss. Market respects those people who respects the market. Market respects the people who trust the markets. So if you had placed your initial stop loss and did not move an inch, you survived and you made money, and you were the one who actually were right on the direction, anticipated the markets were going down, they went down and you made money. So what was your target over here? You can exit at this this support level, because who knows, the market might take support at this point and you still end up catching a huge chunk of the move. Or you can exit your partial lots at this point and then exit your remaining lots at the pivot point, which is going to act as support. In this case, it did not care about the pivot point that much. It actually took the support at S1, but this is how you can scale out. We can talk about that scaling out, scaling in another video, because that is another topic and it keeps on going on. But if you understand how to trail the stop loss, this is how you trail the stop loss. Don't move your stop loss initially when you see a retracement move. I will give you a tip. Keep expecting a move against you when you take a trade. Like for example, if you take this trade, expect if you buy at this point, expect the markets to come back down and go against you for a while, and place your stop loss where you initially placed it and don't move it. So let's say here is your stop loss. Expect the markets to go up, make a retracement move, go back up again and then come back down before actually showing the real move. And this is how markets operate. This is how the system is meant to be, because it is based on fear. It is based on the fear of the people and greed of the people. That is why if you are doing emotional trading, you can never be successful. And that is the reason we need to remove those fear and greed and all the emotions from our mind. Because if we have that fear, it is not going to make us rich. You need to trust the markets, you need to trust the direction of the markets, and you need to trust yourself that, okay, I have taken this trade, it is based on some system, it is based on some logic, it is not a gamble. So I need to trust myself, I need to trust my system. And only after you do that, that is when you actually get rewarded. I hope you enjoyed this video. I hope you learned something out of it. And if you did, then make sure to smash the like button and subscribe to the channel, because I keep coming back with such videos that revolve around trading, trading psychology, trading success, trading technicals, analysis and whatnot. Everything that you need to know about trading, you will find on this channel. So make sure to subscribe. I will see you in the next one. Until then, you guys take care. Bye bye. Peace out.